Well, hi, everybody. Welcome. I'm here today with Mark Sorensen, CEO and founder of 401k Maneuver, offered by Royal Fund Management, LLC, an SEC registered investment advisor. So,
Hi,
Mark,
Michelle.
how are you? Thank you
I'm
for
good.
doing this video.
Thank you.
Awesome. So I know there's a lot of people right now who are nervous about how the November election will affect the markets. You know, it's been the talk around dinner tables, it's all over the media, and I know that a lot of your advisors are getting calls from clients wondering what the heck to do. So what do people need to know or keep in mind, not only for, short term leading up to the election, but also long term after the election happens?
Right. Well, thank you, Michelle, for the question, because yes, I spoke to one of our advisors a couple days ago that said every other call they're getting is about the election and how it affects markets. Let me just start by saying something simple, and that is there has never been a bull market start or end because of a presidential election. Yes, this presidential election is different. They always say it's different, and it is an important one by most people's thinking. However, it can create short-term volatility, but in the longer term, elections don't really matter. They don't start or end bull markets. In fact, it's really more about how the economy is doing at the time and where we are in the business cycle. And as we talk, maybe I can give you some examples of that from the past that will clarify that.
Great. So I think that was really important. You said it's really about what's going on in the market at the time. It's not so important about the election itself. It's really bigger picture here that's what's in play. Correct?
Oh, exactly. The market, as we've always heard, the cliche, the market doesn't like uncertainty.
Right.
And elections can create some uncertainty. However, in the short term, that can create some near-term volatility. The market gets anxious, does well for a period of time, or gets ugly for a short period of time. But longer term, elections do not really have much impact on the pricing of stocks and the valuation.
Got it. And do you have historical examples that you could share with us today about what's played out in the past?
Yeah, thanks, Michelle. You know, with history as a guide, it's kind of fun to look back at some of the elections, and which shows that in the long term, the elections do not really matter. Let me start by going all the way back to 1980. You know, when Reagan was president, before the election, it was all about. The talk was about, look, the guy's a former actor. He's belligerent towards Soviet Union, and he might get us in a nuclear war. Reaganomics, which was later known as his economic plan, would be dangerous and won't work. And yet, during his administration, the economy grew at about 3.5% a year. The S&P 500, the broad market index for the stock market, averaged 14.2% a year. 8 years later, we had George Bush the elder. At that time, they were saying he wasn't a strong leader like Reagan was, who they were saying negative things about before, remember? They said he lacked vision, that, like the fact that he was part of the Reagan administration, they didn't like the fact that they had doubled the national debt. And so there was a lot of concern about Bush the elder becoming president. And yet the U.S. economy grew at 2.2% as measured by gross domestic product, the growth of the economic output. And the market during his administration averaged 15.7% a year. When Clinton ran, they said, look, he's the governor of a small state. He's unproven on the national scene. They worried about tax increases sinking the economy. And worried about nationalizing healthcare and 20% of the economy becoming nationalized or run by the government. And yet, here we go again. The economy grew at 3.9% a year during his administration, and the market actually averaged over 17% a year. George Bush, the younger, they said, look, he's just running on his name. There's a lot of concerns about that. He didn't have any accomplishments. The tax cuts were only going to benefit the wealthy. They were worried about an international crisis because he didn't have any foreign policy experience. And the market the GDP, the growth of the economy, averaged 2.2% a year during his administration. The market average during his administration was down 2.9. But remember, back then we had the tech bubble. In fact, right after the inauguration back then, the market was in a bit of a tailspin. But nonetheless, the economy continued to grow. But there's a point, Michelle. The market wasn't doing bad because he became president. The market was already having a problem. So like I said before, it's not the election that creates a problem. It's more about, how is the economy doing at that time, and where are we in the business cycle?
Right.
Exactly. I'll go a little further, a couple more elections. 2008, Obama, they said he was inexperienced. At that time, as I recall, he only had 2 years as a U.S. senator, so not a lot of experience. Soaring rhetoric, and people were worried about the promises being words only, and he had a desire for a large stimulus and healthcare plan that they thought would just explode the national debt. And yet the economy grew during his administration at 1.6%. The S&P averaged over 14% as well. Trump, obviously, 4 years ago, they said he'd never held a political office. He doesn't speak or act like somebody that could be president or is presidential. Worried about the trade war with China. Damaging the U.S. economy. And yet, up until now, the average of the growth of the economy has been 2.5%, and the S&P 500 has averaged 12% despite the recent coronavirus pandemic.
Got it. It's amazing how if we just take a breath and look back in history, it's all going to be okay. So I do have a question, though. I understand, that markets don't like uncertainty, and it does create the volatility. But what do you say to someone who's nearing retirement and also has 2008? It wasn't that long ago, fresh in his or her mind. What do you say to people who are maybe a year or 5 years away from retiring? Same advice, or what would you say?
Well, I would say same advice to some extent. Again, with history as a guide, and this call today is about the elections and how it affects market. And my argument is that it doesn't affect markets over a longer period of time, though it can create some short-term uncertainty. But for somebody that's near retirement, obviously they might not have all their money in the stock market in the first place. But my argument would be the same, or my advice would be the same. Don't let the election be the reason to make a change to the way you're investing now, because any short-term volatility in the long run, the market will be fine as it relates to the election itself. Got
it. Great. Thank you for that. So is there anything that, well, I actually want to have ask you a question about emotion. As investors, emotion is what will get you every time, so to speak.
Right.
So what advice do you have for people? I mean, at the end of the day, we're all human beings, right? And it's just everywhere. It's the talk of everything, and people are nervous, and people don't like uncertainty, just like markets don't. But what advice do you have on keeping an even keel, and how do you not make these poor emotional decisions in the next few months?
Right. Yeah, it is difficult because you said the words, we're human beings. I mean,
yes.
That's the one unfortunate thing about the stock market. It is driven by human beings, and we are emotional. I would say that you, me, and most of us that are watching this call would probably agree that decisions we've made in any area of our life that were emotionally driven, in hindsight, it might not have been right or may not have been the best decisions. So you've got to really check that. The easiest way to check that is simply to let history be your guide. And that's why I wanted to go back and give some stats about that. Another example, Michelle, is 19 of the last 23 election years. That goes back to 1928 to 2016. 19 of the last 23 election years, the market's gone up. So it hasn't been an overall concern. Now, there have been years when it went down, but
Sure.
it was at the time we were already in an economic crisis. For example, Obama, McCain, the market was down 37% during that election year, but that was '08. Look what
Right.
happened in 2007, 2008. We had the housing bubble. We had what became known as the Great Recession. People worried about going to the next depression. I read a story where some experts were saying we're only 4 days away from complete collapse in our financial system. So those were scary times. But again, that had nothing to do with the election. That was what was happening at the time.
Currently.
And those are things we can react to. On the other hand, when Reagan came into office in 1980, the market went up 32% during that election year. But again, that's not because Reagan became the president. It had nothing to do with the election. The early 1980s is when we started one of the best bull markets in the history of the stock market, where we went up for goodness from 1980 all the way to 2000 with a couple blips along the way. Like 1987, it was good times. Trump. Remember all the anxiety about the election last year, last time in 2016. Yeah. In fact, I remember sitting at home watching that, and the futures, when they finally announced that Trump had won, were down 800 points. I came into the office at 4 o'clock in the morning because we manage money for a living, so that I could be able to react to what was going to happen the next day. As I recall, the market actually closed up that day. So there's a lot of emotion around the election anyway. There's a lot of emotion around investing anyway. But rely on history and try not to make emotional decisions. In fact, even during the pandemic that we just came through with coronavirus, when I was putting out market commentary videos during that time, I was reminding people, do not make emotional decisions, because the problem with emotional decisions is, as I've already said, in hindsight, they're usually not very accurate. But to get out of the market, we've had some clients say, should we get out of the market before the election? Get back in after inauguration next year? Maybe so. We can't predict the short term, but you have to make two perfect decisions, and that is when to get out, and the tougher one is when to get back in. Because we are human beings, if the market goes down a little more, we're going to be concerned that it's going to get worse, and so we're not going to get back in.
Right,
Then the
and
market
you miss that
goes back
opportunity.
up, and we have, then we have the opportunity cost of getting back in. So, emotions are tough to check, but I would just suggest that let history be your guide, and that's why I wanted to go over some facts on this call. But I'd also say, if you have to, just ignore it. And then keep in mind that, the media, your neighbors across the fence, your colleagues at work, all the talk about the election, it creates a lot of fear and anxiety, and you just have to, put a plug in that if you can, like I said, even if you have to ignore it. And remember, I don't know about you, Michelle, but when I was a kid, there used to be stories on the news, the nightly news, about the Boy Scout that walked a grandma safely across the road. You don't see those stories.
We don't do that anymore. No, no.
There's even I think there was a song about, dirty laundry sells. Negative news sells. It attracts eyeballs, and that's what the media wants. So, the media tends to make it worse in any event. So you just try to insulate yourself from that, and the easiest way to do that is to look at history. In fact, I'll say one more thing, and you may have some more questions, but the market is, the stock market, I can't make guarantees, of course. I can assure you one thing, 100% of the time, the market has always come back from any correction, or for that matter, any bear market. You've got to be patient. You did ask about people that are close to, in retirement, near retirement. I would say the argument is the same, because the economy is doing okay right now. Don't make a decision because of the election, but obviously in terms of your asset allocation, you may not have all your your money in the market in the first place in that situation.
Got it. So what I'm hearing you say is that if you freak out, look at history, and that really it's not elections that drive markets and economy. And yes, it can create some short-term volatility, but it's really about what's going on in that particular economic cycle at the time, big picture wise. And just breathe. I think that's right.
Yeah,
and carry on.
Yeah. I jokingly, but read a book, play golf,
Right.
get some comfort food, eat a bowl of ice cream or something, but try not to be emotional about it. A couple other stats that might help people is that when the incumbent loses an election, there's a new administration. The market the year after the election is averaged 5% historically, and when the incumbent wins, it's averaged 6.5%. That's not to say one is better than the other. It's just to drive home again the point that making investment decisions because of the election is probably not the wisest thing to do.
Got it. Great. Well, that's all the questions I had. Is there anything else you want to add, or are you good?
No, I would just say that the market, as we speak, is in a little bit of a backing and filling, correcting mode. But again, that's not because of the election. The market got a little bit of ahead of itself, and I would just suggest that with the Fed supporting it and fiscal policy supporting the market, monetary policy, we think any pullback right now is probably an opportunity. In fact, I saw an interesting quote recently, Michelle, that said lower prices create higher returns. And what is meant by that, as long as you stay in the market, lower prices are necessary every now and then. It creates a better foundation or a stronger foundation to sustain the next move up.
For sure. Love it. Thank you so much for this. I'm sure everybody watching will hopefully have learned a lot, and really, really appreciate it.
You're quite welcome. Thanks, Michelle. Thanks, everyone.
Yeah.
Bye now.
Thanks, Mark.